Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Aisha Faridi. And for now, the market continues to be in the red. Yes, it's off the lowest point of the trading session, but there's no material recovery as such. We are still down about 50 points for the Nifty. The Bank Nifty continues to underperform. Having said that, today the small cap index is clearly outperforming. So while rest of the market was firmly in the red, small cap index was largely in the green. Let's see whether it's maintaining suit now. No, it's actually just about moved into the red, and it's actually toggling between the red and the green. Having said that, if you look at the NSE index right now, there are 182 stocks which are actually hitting fresh 52-week highs, while there are only 16 stocks which are hitting 52-week lows. So there's a lot of still vibrancy in the markets wherein you are seeing individual names do well. Talking about individual names, L&T from the frontline index is up a solid 3%. There was a CLSA note as well as an Axis Cap note talking about how the fundamentals seem very strong. Power Grid is doing quite well, and Adani Enterprises is the other name. However, from the losing side, Asian Paints continue to reel under pressure, so there's no recovery on Asian Paints, no buying on dips, etc. happening. From the Adani pack, watch out for Adani Energy as well. That stock is up 9%. Policy Bazaar 7% higher. 361 is the other one, and then Paytm. That stock is locked in upper circuit. So a lot of individual movers, Aisha, but I think on the downside, we need to watch out for Alkem as well.
Oh yeah, Alkem, considering sources are telling us that the income tax department has found large-scale tax evasion. That stock is, of course, taking a whack. The volumes as well picking up, now down over 6% as we speak. On the other hand, though, you've got a Glenmark Pharma, which is scaling up by about almost 4%. There's been an upgrade from the House of Investec, target price at 1,090, and that's clearly auguring well for this one. Asian Paints, again, reeling under pressure. A CLSA downgrade coming in from the earlier underperformed to now sell. Target price cut as well. From the earlier 32.15 to now 24.25 on Asian Paints. So that's another stock which is reeling under pressure as we speak. And then, of course, Reliance Industries, they've come out with their numbers. It's been weak. The stock was down about almost 7%. The revenue has seen a downtick of about 25% or so. And there's an EBITDA loss as well to the tune of 612 crore rupees. That stock clearly under pressure. But let's try and understand the texture of the market, which is turning out to be a rather stock-specific day. C.A. Rudramurthy, Kunal Bothra, both of them join in on the show right now. Kunal, hi, afternoon. Let me come to you first. A word on the index, because the index largely is consolidating. Of course, there are a lot of individual stock-specific movers here and there. But at an index level, what are the levels to look out for next?
Yeah, it's been a very somber day so far for the indices. When you look at the Nifty and the Bank Nifty, the movement for both of these indices, except for the intraday recovery of, I think, some 80 odd points on the Nifty and 100 plus points on the Bank Nifty, it's been more or less a day where the action is just restricted towards few mid caps and large caps. And also, I think one of the other concerns which you're seeing is the lack of liquidity across many stock specific segments. So, for example, if stocks over the last couple of days, we've seen a rally of 4-5% for themselves. If they're going to a patch of consolidation, it's happening on the back of extreme lack of volume. So the bid-ask spread to these stocks is a bit more on the higher side. That itself tells you that there's not too much of activity chasing the kind of price movement for these names. So traders are more or less looking to buy these stocks on phase of correction, as well as are not looking to chase momentum into these names, and that's why you're seeing the index movements also being a lot more restricted. Net, I would believe that we are still trading with a positive bias on the index till the time we trade above that 21,900 mark. So that's a key support point from a short-term trading perspective. And for the Bank Nifty, I would probably peg that level closer to 46,500 mark, which we've tested multiple times on an intraday basis also.
Okay, so that's a take on the market, but do watch out for India Wix. That continues to surge. It's the week of the monthly options expiry, so that could have perhaps added to that. But the last time I checked, the India Wix was up around 4 to 5%, so actually close to 16 now. C. Rudramurthy, what's your view on the market, and what about the Bank Nifty? It's been one step forward, two step back for it.
See, for me, index is just consolidating after a good up move, and there is no signs of weakness yet. This is a market which is still a buy on every dip. Look at Nifty, that strong support is at around 21,800, 21,900 zone. From there, repeatedly, market is definitely bouncing. And also look at Bank Nifty. For me, levels closer to 46,200, 46,300 holds a very, very strong support. So now HDFC Bank, Reliance, all these stocks are also performing. So I don't see any shorting opportunity for sure. This is a buy on every dip market. 8 out of 10 people are cautious on market, and these people will provide support if we find any dip in market. So for me, this is not a market to short. Buy every dip and be very, very stock specific. In banking, specifically HDFC Bank and SBI looks a very good buy even at current level, or on any dip, it's a buy.
Let's address some of the news specific movers, and we just highlighted that Alkem Laboratories, that's the one which is taking quite a whack right now. In fact, we are exclusively picking up that the income tax department has found large scale tax evasion by the company. Rajesh Singh joins in right now with more details on the phone line on what he's picking up from his sources.
Raid or survey was done on Alkem Labs in September last year, and Income Tax Department has seized many documents. On investigation, now we have found from sources that they have found tax evasion of over 1,000 crore rupees. The thing is that Income Tax Department, as per rules, they give certain incentives on taxes if you are setting up an industry in Northeast. What Alkem Labs has shown, they have shown that large-scale manufacturing in their Sikkim manufacturing plant, and that took tax evasion, when bogus deductions were taken on the manufacturing in the Sikkim plant. So IT department has found over 1,000 crore of such tax bogus declaration they have done. Secondly, they have also given large-scale cash to doctors for prescribing medicines of Alkem Labs, produced by Alkem. So all these things have the Income Department have found approval. Very soon they will file the final report of this investigation. And as per sources, they are telling the heavy penalties can be imposed on Alkem Labs for all these bogus declarations, and that penalties can be up to 3 times of the bogus declaration.
Okay, so that about Alkem Labs, though it's off the lowest point of the trading session, still continues to reel in the red. Glenmark Pharma Investec's view is a bit delayed because most of the details were actually out after the rupees. Debt, which was the biggest overhang for the company, is expected to go away. US business is back to growth, plus the margins are expected to improve from here on because all of that R&D spend that the company was doing will go away, and there'll be that operating leverage kick in that will happen at the bottom line. But Kunal, what's your view on the charts of Alkem Labs? Should one do bottom fishing? And what about Glenmark Pharma? What's the level to watch out for?
So I think Alkem Labs, purely on the basis of this news flow, I would probably avoid, because after such kind of sharp volatility, if stocks generally retest the previous lows, we expect a fresh leg of breakdown to happen into these names. So I think it's always better to try and wait out for a point when the volatility settles down and the stock comes back towards a breakout of today's high. That's closer to 5,400, 5,413 on the spot levels for Alkem Labs. So I think only a break above those levels is where one should look to initiate a buy on the stock. For Glenmark Pharma, on the other hand, I think the stock has been a remarkable comeback over the last 12-18 months approximately. From a point when the stock was almost at 500, 550 mark. Even in the last 2-3 months, the stock had gone through a phase of correction. It had come back to, I think, 800 levels, broadly or sub 800 mark, had come back towards below the 50 moving average. But the comeback in the last 2-3 months after this 20% odd correction for Glenmark Pharma has been just about outstanding. And my sense is that the stock looks very attractive even at current levels of 900. So with a time frame which is more of medium to longish term, I would believe Glenmark Pharma could be something which should be initiated even at current levels.
Okay, that's the take coming in on Alkem and Glenmark Pharma. Asian Paints, that's the one which we've been monitoring of late. Of course, the pressure on the stock started building up when you had Grasim launch its paint business. But that said, couple of downgrades as well, like we've been marking out. They've been now trickling in on Asian Paints. In fact, Shesha is here with more details on the 2 notes coming in on Asian Paints, one from CLSA as well as the other one from Goldman Sachs.
Well, yes, a slew of brokerage notes have come in this morning. The stock is reeling under pressure. First up, let's talk about CLSA, which has downgraded Asian Paints to a sell rating from their earlier underperform rating. They've also gone ahead and reduced their target price to 2,425 from their earlier target price of 3,200. They say competition is likely to intensify much more than earlier anticipated. They've cut their FY25 and 26 earnings estimates by 8 and 10% respectively. But guess what? It's not just CLSA. We also have a note that has come in from Goldman Sachs, where they are maintaining their neutral stance on the stock, but they've cut their target price to 2,850 from their earlier target price of 3,300. Meanwhile, they've also cut their EPS estimates by 5 and 11% respectively for FY25 and 26. They've lowered their target multiples to 52 times from their earlier target multiple of 58 times. They say Birla's entry into the paint segment has been more comprehensive than earlier anticipated, and hence the downgrade that has come in. Lastly, Macquarie, where they are maintaining their outperform stance with a revised target price of 4,000. They say they are preferring Asian paints over smaller players like Berger Paints, which are likely to be more impacted. Perhaps a slightly positive report from Macquarie, where they are maintaining their stance with a target price of 4,000.
Okay, Ashesha, thank you so much for putting that into perspective. But paint stock, including Asian Paints, Kansai, Berger, they're all taking a bit of a knock, given that impending competition is not a very good news for the top line or the margins of all of these companies, though some of them are off the lowest point of the day. Time now to take a short breather on the show. Don't go anywhere.
The index hit all-time peaks. Right now, of course, we're absolutely quiet around that 22,200 mark, week of expiry. That's where Nifty futures are currently. But let's welcome on board Varun Lochrab and figure out what he's making of the market texture right now. Varun, hi, afternoon. Good to have you on the show. You think the need of the hour is some consolidation for the market to catch up some breath? And what triggers would you say is keeping the markets at higher levels, you think?
Yeah, hi, good afternoon. So you're absolutely right. We believe it's time for some consolidation in the market, which will be quite healthy because valuations have been running slightly ahead. I think what has been the positive is that earnings season has again been fairly good. There were around minor upgrades of around 1% to our estimates for both FY24 and 25. So this was another quarter of 20% plus earning growth on a YOY basis. However, we believe this will also fade away as we get into FY25 because the benefit of lower input cost is largely coming into the base after 1 or 2 quarters. So we have probably one more quarter left, which is Q4, when you will see strong margin expansion on a YOY basis. And then FY25 earning growth for our coverage universe is around 9%. And most of the sectors have hit sort of their steady state or above normalized level of profitability in FY24 itself. So I think some consolidation in earnings will also happen, which will probably keep markets in check, and markets should remain range bound in our view at an index level.
Okay, point taken. So that's a view on the index and how earnings are supporting that. But Varun, what are those fresh ideas that you have or your team has generated of late? Any fresh buy ideas?
So, see, overall, obviously, it's getting more and more difficult to find undervalued or undiscovered stocks because, as I said, there is no sort of obvious picks left in the market. We were bullish on energy space and OMCs and power and real estate. Most of them have played out last year. I think incrementally, when I look at FY25 and where earnings are probably in our coverage universe, where we are expecting a pickup in earning growth vis-a-vis FY24. One is obviously IT, but stocks have already run up in anticipation of that. So maybe few select stocks could be bought out there, but at an aggregate level, not much. Metals is where, especially steel, is where we see there is possibility of some upside in FY25 if China demand does not fall, further from these levels. And if there is any minor pickup, we believe some of the steel stocks could potentially offer some upside into next year. But barring that, frankly, we are largely continuing with the earlier themes, which was, industrials, power, real estate. Though we are taking some money off out there, we have cut our bets out there. We've increased our cash levels a little bit in our model portfolio. And it's going to be more selective and more bottom up. So not too many ideas, frankly, at this point of time.
Struggling to think where is it that you're finding those bottom-up ideas to begin with. But maybe private banking could be one space, right, Varun? Because that's starkly underperformed as opposed to what some of the PSU peers have done.
Yeah, so private banks, we are fairly well positioned already in our model portfolio. We have ICICI Access among the top bets out there, and then we have SBI and Federal among the other banking names. I think banking is going to be range bound in our view. Earnings next year will be in low to mid teens, and valuations, you are right, there is no froth out there, fortunately, so that protects you from the downside. But I think the upside also gets capped because your credit cost and NIM are not going to get any better into FY25 compared to 24. So earnings will see a bit of deceleration even out there. And therefore, the absolute upside may not be a lot even in private banks, but it's a good space to be in, given the fact that our overall expectation from index also is not very high now. So yeah, private banks, we continue to be well positioned in our model.
Point taken, but since you're not expecting a big gain out of the frontline index, I'm guessing a bit of a change will be there on account of the sector churn, etc. Do you believe the likes of autos, real estate have peaked out and one should start booking profits and probably start putting money into FMCG or even IT and other sectors of the world which have been on the back foot?
Yeah, so I would not say that one should completely reverse out there. So as I said, what we have done is we have taken some money off autos. We have now gone underweight after almost 2 years of equal weight or overweight stance. So autos, I believe, is slightly overheated even out there. There will be a deceleration in earning growth in FY25. The benefit of lower input cost is already there in the P&L now. Real estate, yeah, I think near term they are looking probably a bit stretched, while residential upcycle will continue over next 2 to 3 years as well, which has been our call on industrials also, that the private and the government capex will continue to be robust. But I think all these spaces need a bit of consolidation into FY25. So therefore, we have been taking some money off from these places. Consumer staples and discretionary, frankly, we have still not increased our or reduced our underweight. We are still negative. IT, yes, we have cut our underweight and it's more like a neutral now. So yeah, we are getting into some of the sectors which have not performed as well in FY24 as a rotation theme into FY25, but not across the board. So metals, as I said, we have increased our weight from underweight to neutral. We believe cement and building materials could also do a tad better in FY25. So there will be some rotation, from some of these overheated sectors into the sectors which have not done as well in FY24.
Okay, that's the take coming in on some of the sectors over there. But in the meantime, Varun, wanted to understand what your view on consumption is at large. And let's pick up on the FMCG side of things, because the pressure is clearly to the rural exposure plays. You think that's also a bottom-up story that could be looked at? Or do you think, the green shoots will take some time to actually come up?
Yeah, so I think it's again a bottom-up story. Certain companies like Tata Consumer and all are still growing well, or say Nestle, which are less exposed to rural. So you have to look at each company's portfolio and see what actions they are doing in terms of new innovation, launches, distribution expansion. So a lot of things go into determining the growth rate. But at an aggregate level, rural demand still continues to be fairly muted. We believe, while it's not seeing incremental worsening for sure, there is modest improvement, and we believe that will continue, as the inflation level cools off, and you will see better volumes coming through. But still, value growth will remain in, mid single digit kind of a levels, at least in the first half of FY25. So therefore, we believe there is no basket case of going overly bullish on consumer staples and FMCG, because there is not going to be any V-shaped recovery in rural in our view. but it's improving at the margin in terms of demand scenario. So we believe that should continue, but it's a very gradual sort of improvement rather than a very V-shaped improvement.
Okay, not expecting a V-shaped recovery in the rural consumption. Thanks, Varun, for making time and speaking with us. But let's take the closing ideas from our technical experts as well. Kunal, you go first.
Well, in terms of closing trade, I would look at SBI Life. In fact, many of the insurance stocks are actually making a fresh swing high for themselves. SBI Life also is something which is looking attractive. In fact, it's one of the best performing insurance stocks within the pack, and I would believe that at current levels looks attractive for a swing trade of at least another 5% to 7% on the upside.
Okay, on that note, let's take a very quick break. That's a buy coming in from Kunal as a closing strategy on SBI Life. When we come back, the last half an hour of trade this afternoon.
Welcome back. Well, Voyage 2024 is around the corner, and global experts, Indian policymakers, economists and industry stalwarts will all be in attendance at the 10th edition of Aditya Birla Sun Life Mutual Fund Voyage. Collectively, they'll dissect investing opportunities in a dominant Bharat. You don't want to miss it. Stay tuned to ET Now on Wednesday, February 28th as we bring you this exclusive coverage from the Voyage 2024. The markets and seeing what's happening at the index level, there is not much of a recovery underway. We are still at 22,141 and the Bank Nifty continues to reel under pressure. We didn't take the closing idea from Rudra Murthy, so let me take it across to him and get a sense which charts or which stock look interesting.
Market definitely is a buy on dip, and we have to get into the right stocks. At index level, yes, we might see some amount of consolidation. So for me, Indus Tower looks very, very strong. This stock, having consolidated in the range of 220 to 240, is now trading way above those levels of 240. So keeping a tight stop loss of 240, I'll be looking at initial targets of 265 on Indus Tower, and even eventually 280, 300 is possible positionally on Indus Tower. Available in futures, one can definitely go long in March series.
Okay, point taken. So that's a view coming in as far as Indus Towers is concerned. Has had a very good run, and that impending meeting of Vodafone on 27th or 28th, I believe, is something, of course, the market is looking forward to as well. But Kunal, what's your sense on L&T as well as Reliance? There were a couple of brokerage notes this morning. What's your sense with respect to L&T, where it's headed?
So I think L&T looks attractive. In fact, last week on Wednesday, I had initiated a buy in L&T when the stock was almost at 3,350, 400 levels, anticipating two patterns being completed for the stock. One is a major retracement, a Fibonacci retracement for the stock at the 3,350, 3,400 levels for L&T. And the second, the more important point, was the stock coming back above the 50-day moving average, which it has confirmed today as well, along with much higher volumes as compared to last week. So that indicates that the stock has completed a major corrective pattern for itself and now is getting back into the thick of price uptrend. I would believe that possibly in this leg of uptrend, the stock has potential to even come back towards 3,500, 3,600 mark, possibly over the next few trading sessions. So would expect at least another 3% to 4% jump into the stock over the near term. Reliance Industries, on the other hand, I would probably believe is again a stock which is looking very strong, but then it has this odd habit of going into a patch of consolidation and a very narrow and a tight range consolidation, which we've seen for the stock happening over the last couple of days. In fact, if you look at the last 1 month, the stock has risen up from 2,800 mark towards closer to 3,000 levels. But it's been a very gradual and a very grinding kind of a rally for the stock in this last 1 month. So, which means traders would probably have to have more patience into this name rather than expecting a very strong flurry of price action in a short contracted time period. I think it's better to have a time frame of at least 1 to 3 months, expecting another 200 points up move.
Okay, that's the take coming in on some of the large caps, L&T and Reliance. Mayuresh Joshi as well joins in on the show right now. Mayuresh, hi, afternoon. What's the market construct looking like, and what do you think is going to be providing triggers from here for the markets?
Afternoon, Aisha. I think the market looks in fine fettle as we speak, and both the macros and micros, as far as India is concerned, are holding out pretty well for the markets. Having said that, and as the earnings season has progressed for this quarter, a large number of corporates have posted decent set of numbers across sectors. So I think the micro environment probably looks very well placed. Also, from an overall corporate debt perspective, we are around 0.5 times, which is at a decadal low for corporate India as far as the debt levels are concerned. And even within the banking system, the kind of net NPAs that are now present in the system gives hope that earnings should continue to be on a very strong footing for the remainder of this year as well. So I think the base case scenario that is probably getting built in for a 12 to 15% earnings growth might very well continue. Obviously, the next quarter, when elections will probably start, and the order of elections will probably start happening, the expectations in terms of order flows for the capital goods industry probably might get a little patchy. But the expectations for the next financial year remains very, very robust, along with the macro numbers that the Exchequer has also given in terms of both the GDP estimates as well as expectations of a lower fiscal deficit. So I think it is expected that earnings will probably hold up the market, because that's ultimately the crux on which the markets hinge upon. Domestic cyclicals, in my opinion, will continue doing well. We remain constructive on banking and financial services, because at some point of time, as the rate cut starts happening at the end of this calendar year, I think a strong part of tailwind should start coming back in the second half of the next year's earnings as well. And consumer discretionary, very, very selectively, should start coming up very, very robustly as well. So I think domestic focused and oriented sectors, in our opinion, at Markets Per India should continue doing well. We remain constructive and positive on the markets.
That's the comprehensive take on the Indian markets right now. Earnings definitely supporting the move that we are seeing. But Mayuresh, what's your view on Asian paints and the rest of the paints pack?
Afternoon, Anisha. With the entry of the new entrant and the expectations that they have probably laid out, 10,000 odd crores in the next 3 years as part of the top lines, the capacity that the new incumbent is probably expected to get into the market, which is going to exceed the capacities of the number 2, 3, 4 player. Obviously, there is going to be a huge action as far as pricing is concerned. So to that extent, I think a lot of the other players, Asian Paints as an example, has already embarked upon a capex plan to expand its capacities. Berger, Kansa and Aerolac have also started doing relevant amounts of capex to expand their capacities. So I think as more volumes start coming through, and with very aggressive pricing that can happen across segments, we are probably talking about emulsions right up till distempers. So I think the entire value chain, right from premium paints to entry-level paints, are going to get disrupted as far as pricing is concerned. And that is definitely going to have an impact on the existing players as far as margins are concerned, and probably derate some element in terms of the forward P multiples that they were probably getting. So my take is that they will still struggle as this entire phase starts going through in the next 2 to 3 quarters. Is there sufficient headroom for a lot of these organized players to grow? Absolutely yes, Anisha, because I think 35% of the market is still unorganized, and there is huge expectations that organized players will take a larger chunk. But I think over the next couple of quarters, to say the least, there will be a derating as far as forward multiples are concerned, and the high premium multiples, Asian Paints, Kansai, Berger, that used to derive before the entry of the new player, is obviously going to come off. So yeah, I think it's going to be a little bit sticky for these players as far as numbers are concerned. So I think I'll be better off looking at other themes into the market. This theme might probably just consolidate for some length of time.
In the meantime, while L&T is a gainer today, CLSA has come out with a note on the company. Let's try and understand what the takeaways are. Vinny is here with the details.
L&T also is in focus on the back of a brokerage note that we have that's coming from CLSA. Now they're maintaining a buy rating, target price of 4,260 rupees per share is what they've given. Concerns around Middle East and whether there is Middle East or no Middle East in terms of that. What CLSA is highlighting that the Q4 orders that are looking for L&T are quite attractive. They are ahead of what is estimated for the company as well, and what the street is estimating. So yes, in terms of that, the India orders are quite strong for the company, and they are set to beat their own guidance as well as the street guidance as well in terms of order win. Other than that, they believe that in India, the Indian orders are something that is shining out for L&T, and this is the right time to start winning in terms of the orders as well, defense orders as well. Let's not forget, the Cabinet Committee of Securities has cleared orders worth around $3.9 billion, which includes $1.6 billion in high-power radars as well as close-in weapon systems as well. And in that, they're expecting a high-power radar order worth around 6,000 crores, which is expected to be placed with L&T, and that will be before the March 2024 as well. So Q4 could shine out for L&T, and that is something they're positive on, and that is why they're maintaining a buy rating given a target price of 4,260 rupees per share for L&T. On the back of this, that order wins are something that will work out well for the company. Diverse portfolio as well as that will be driven by premium valuations is something they're watching out for.
Okay, L&T, that stock is definitely in focus on account of that. Taking a look at some of the other buzzers and take a look at Sobha. That stock is suddenly up 10%. Of course, on the other hand, Phoenix Mills was retracing today, but there's something definitely going on with Sobha. Rudramurthy, can I take your, chart check and insights on Sobha as to what's happening there, or any other real estate stock that you like?
Real estate will be the sector for the year, and I've been calling real estate as the sector which can do very good in 2024. In fact, Sobha is one such stock which is just making that higher top, higher bottom formation. Now support for the stock is way down, and any good level to enter for this stock will be at around 1,400, 1,450 level. But even at current price, I will be a buyer in Sobha for a momentum buy, and it has even given a small breakout now above its recent highs which it had made at around 1,575. So stock for me is a buy on every dip, and real estate as a sector will do very, very good. I'm even bullish on DLF, a stock available in future, and DLF is headed towards that 4-digit mark very soon. Even Godrej Property looks very good from the real estate pack, because again, these are two stocks, both DLF and Godrej Property, available in F&O. So for me, these two stocks will do very, very good. I even like Sobha, I like Oberoi Realty. These are all stocks which will still continue to do good. Have it in your portfolio, buy on every dip. If you are an F&O trader, keep rolling it over and it will give you handsome gains.
It's a buy coming in on Sobha, even after the run-up that the stock has seen, nearly 10% in trade as we speak right now. But let's shift focus to some of the tactical ideas coming in. And JP Morgan has got a positive catalyst watch now on GAIL. Morgan Stanley has chosen PNB Housing as a tactical idea. Gaurav from our research desk is here with the details.
So when we talk about GAIL India, JP Morgan has now put it in the positive catalyst watch, and the reason being that GAIL's trading segment, now JP Morgan believes that the trading segment will report strong set of numbers in Q4 FY24. But if you look at the consensus number, they're expecting overall earnings to go down almost by 14% on a quarter-on-quarter basis in Q4 FY24. And on back of this, they believe that any kind of positive surprise in the earnings is likely to be a key catalyst for the stock. And apart from that, if we also look at the gas trading spreads, they are also widening, and this is also going to support the price, and that is why they have maintained neutral rating but has increased the target price to 175 rupees per share. Let's also talk about PNB Housing, because now Morgan Stanley has put a tactical idea as a PNB Housing, and they believe that the share price of PNB Housing will outperform the broader index in the next 60 days. And the reason being that if you look at the current valuation for PNB Housing, it is trading at 1.1 times the price to book value, and this valuation is a little attractive for if you look at Morgan Stanley's view. And apart from that, they also believe that NIMs for the companies are also likely to be supported because of the credit rating upgrade that we have seen for the company. And on back of this, they are now pitching it as a tactical idea, and at the same time they have also maintained outperform rating and a target price of 970 rupees per share.
Okay, Gaurav, we'll leave it at that. Let's shift focus now to the Adani Group, which is planning to enter various sectors over the next 2 to 3 years. In fact, the Ports to Power conglomerate is planning to launch 5 IPOs over the next couple of years. This includes the likes of Adani New Industries, that's going on to focus on alternative energy investments and manufacturing. There's also Adani Airport Holdings, which currently manages 8 airports and aims to add 8 more to its portfolio by 2026. And then, of course, there is a data center infrastructure company which plans to list the entity by the name of Adani Connex.
Well, yes, joining India's move towards a Viksit Bharat, another infra-centric entity from the Adani pack, one that will remain focused on transport and utility infrastructure Construction Services, the metals and mining entity that already owns world's largest copper producing site with an extended focus, will also be entering into the aluminium and iron ore refineries of Orissa as well as Chhattisgarh respectively, and a large scale up is expected of these businesses over the course of next 2 to 3 years. Okay, so that was about the Adani group of stocks, but let me pose it to Mayuresh as well. Mayuresh, within the entire Adani pack, which are the stocks that you like at this point of time?
I think this development is definitely going to create a huge sentimental impact onto the stocks, Anisha. And as I've always maintained, I think 3 stocks out of this entire pack look attractive over a longer period of time structurally. Adani Ports, as an example, where the expectation largely is a large part of the mechanization that has already been part and parcel of their operations should continue growing at a very good clip. And with expectations of global trade normalizing, albeit the Red Sea crisis that we're probably seeing might have an issue for a quarter or so. But I think it should normalize over the next few quarters and improve thereafter, giving a sustainable growth in terms of the number of volumes of the containers that they will probably handle. So to that extent, I think the kind of numbers that can come through from Adani Ports can still be better every passing year. And both the cement counters, in my take, Ambuja and ACC, where a lot of capex activity that has been announced by the government and expected to be doing so over the next few quarters should continue at a very fast clip. Obviously, the capacities that both of them have at this juncture and the expectations in terms of more capacity building happening incrementally over the next few quarters at a much lower cost in terms of the brownfield expansion should probably mean better volumes with no additional stress or a large stress in terms of their balance sheet, creating significant amount of leverage over the next few years. So I think these 3 stocks from among the pack, Ports, ACC, Ambuja, on any decline can probably be looked at.
Right, okay, that's the take coming in the cement sector. But ahead of today's Finance Ministry meet with fintechs and policymakers, we caught up with the MD and co-founder of Razorpay to hear out what the industry's key asks are, and also spoke with Shashank Kumar, the co-founder of Razorpay, about the plans of listing on D Street.
We are in the process of flipping our domicile for Razorpay from US to India. And a major factor for it is that eventually we want to list in India, right? Because we are serving all the Indian customers. And this is where our home ground is, and this is where we see our long-term growth, right? So yeah, I think more from an IPO perspective, I think we want to hit our internal milestones around the company flipping back to India, as well as the scale that we want to achieve on the new products and the profitability that we expect to achieve there. I don't think there is absolutely any systemic issue, that exists in the ecosystem, right? I think the regulator has been fairly progressive and if I can say, like, to an extent, innovative as well. And the last 10 years, the progress that we have seen on digital payments, on UPI, some of these wouldn't have been possible without regulators' proactive support and thinking and vision for the country, right? And I think all of us have benefited mostly, from the regulators' policies and actions that are there. There has been fairly good, if I can say so, regulatory support and institution support to partner with fintechs and to build new products. I think some of that needs to continue. What I would say, like, more on the fintech front is that from a credit perspective and from a banking perspective, right? How do you deepen the engagement that is present with fintechs?
Okay, we were discussing the entire infrastructure theme earlier, and of course, Mayuresh, we have recently seen a lot of these announcements come by, whether it was the railway sector or the other segments as well, defense, etc. Which within the entire of this infrastructure pack do you think will lead growth going forward?
I think a large part of the market has probably moved. So if you look at the capital good players as an example, Anish, I think very good set of numbers, no denying it. ABB, Cummins, Siemens, all had brilliant set of numbers. And therefore, I think the kind of moves that all these stocks have delivered, specifically after the numbers have got announced, has been mind-boggling. So to that extent, I think when you talk about domestic cyclicals, domestic capex as a theme, capital goods as a theme should continue doing well. more orders coming their way, better margin orders, the execution timelines have improved, which means a clear operating leverage getting played. But I think a lot of these stocks, as we see it at Markets Bit India, have moved up quite significantly. So we will wait for pullbacks on these ones. I think one pocket within this entire space of capital goods, cement, infrastructure, which have not moved as much as the others, are these road construction companies. Now, again, I think a lot of capex has got announced, a lot of funds have been earmarked. And as we see, the road minister, Mr. Gadkari, is very, very ambitious over the next few years as well in terms of rollouts and more highways coming through, last mile connectivities as well. And therefore, I think most of these road construction companies, KNR Construction as an example, Ashoka Buildcon, PSP, I think most of these road construction players should continue doing well within this infra theme. My take is that more orders coming their way, better execution of these orders, better margins at which these orders are coming through. Leverage is not that much for most balance sheets within the space itself. And a lot of players are monetizing a large part of their assets as they are fructifying to a close, which probably also alleviates a lot of the equity investments required for the other projects, working capital requirements, as well as excessive amount of debt onto their books. So I think this space within the infra pack, Anisha, should, in my opinion, do well over the next few months.
Okay, that's the take coming in on some of those names. Let's just see what the market is settling in at. And still pretty quiet for the index, or at least that was the case just a few odd minutes back, because now you're seeing a sharp dip actually come by. We're 99 points lower, equating to about a 0.5% downtick. While Asian Paints continues to reel under pressure, some of the metal names are the ones which are cooling off. So Hindalco, Tata Steel are both lower. There's, of course, pressure coming in from the private banking name. HDFC Bank, for instance, has turned tide. It's now dipping into the red as we speak. SBI has flattened out. IndusInd, Kotak, ICICI Bank, in any case, have been under pressure. And then, of course, Reliance Industries as well. That's also seen a sudden drop. It's now in the red as we speak, pretty much around the lowest point in the day. 29.74 is where that stock is. Flattened out for a Bajaj Auto, for M&M as well, which are just about barely holding their head above water. That's the case with the Tata Motors, Sun Pharma too. But Kunal, just on the charts of Reliance, while of course there is no material dip, anything coming in, but you see some consolidation in the days to come?
Yeah, some consolidation, but I think the bias is still very positive for the stock. In fact, my sense is that the expiry action is one of the major triggers why you're seeing some bit of writing on the 3,000 call option. I think that's one of the major reasons why the stock has been unable to surpass these levels, even after a very steady, gradual, but a very consistent kind of a trend for Reliance Industries on the upside. Hopefully, at the start of the fresh expiry, which is on the March series, by this weekend, we could probably expect the stock to gather momentum and break past about this 3,000 levels for itself on the spot basis. But I believe that traders who are holding on to the long positions, who've been buying the stock earlier, I think should continue to hold on. At best, maybe a 3-day swing low could be kept as a trailing stop loss for Reliance Industries. That would probably come back towards 2,900, 2,920 mark for the stock over the very near term.
Okay, point taken. That's Reliance Industries. But on that note, let's take the BDSC trades. Rudramurthy, what's the buy today, sell tomorrow idea, or is it STBT?
No, for me, it is BTST, and this market is a buy on all dip. So stock specific, I'm going long on Biocon. This stock having consolidated at levels closer to 260, 270, made a move up to that levels of 300, and now again has given another dip. Stock was in ban, and that was one of the reason why stock came down. So I feel at current level in equity, one can definitely buy Biocon, looking at targets of around 280 to come for BTST and eventually 300. Keep a tight stop loss of 265. ONGC also looks very strong to me for a BTST trade. Look at ONGC for a target of 278 with a stop loss of 265.
Okay, so that's the BTST idea. Kunal, what about you?
So I'll go with two buy calls. PI Industries is the first stock which I would suggest as a buy. Preempting a breakout after 3-4 days of consolidation. So 3,900 as a target, and stop loss could be kept at 3,600. And Patel Engineering is the other stock. Midcap.
Share on this edition of Closing Trades, but let me take it across